Imagine you wake up tomorrow with a completely empty portfolio. No positions, no bags, no regrets. Just cash. What do you buy? That's exactly what this video is. If I started investing today, from zero, these are the 20 stocks I would build my portfolio around. We're covering 7 sectors: consumer stocks, metals miners, uranium, software, fintech, AI infrastructure, and the biggest allocation of all, data center stocks at 25% of the portfolio. One more thing, it was brutal to cut down to these 20 stocks. If you look in my Discord, I made some game-changing updates. You can now see my entire stock portfolio updated every Friday after the market closes. You will notice that I have over 60 individual stocks in there. I call it a small S&P 500 focused on undervalued growth stocks, basically the best picks of every sector. But for this video, I had to cut my 60 positions down to only 20. So I chose the ones with not too much risk and made sure it is well diversified, with stocks coming from 7 booming sectors, starting with consumer stocks. This is a 15% allocation in the portfolio and contains 3 stocks. The first that is now offering you the buy opportunity of a century is called QXO. This stock is now offering you the buy opportunity of the century. Now down 50% from its all-time highs. This company is Brad Jacobs' latest project. And if you don't know Brad Jacobs, he's the guy who built XPO Logistics, United Rentals, and multiple other multi-billion-dollar companies from scratch. The plan? Roll up the massively fragmented building products distribution industry, an $800 billion market that still runs on phone calls and fax machines, and modernize it with technology and AI. The risk? Success depends on smart acquisitions at fair prices. If the deals disappoint, so does the stock. Next up, we got the most overlooked stock in the stock market, which is called FUBO, the sports-first streaming platform, and the story completely changed when Disney combined Hulu plus live TV with FUBO, taking a controlling stake. Overnight, FUBO went from a small streamer that's fighting giants to a much larger player with Disney as its biggest backer, plus a massive cash settlement that fixed the balance sheet. The bet here: live sports is the last thing keeping traditional TV alive, and FUBO is positioned to capture those who refuse to give up sports. With 6 million subscribers combined, the scale finally makes the business model work. The risk here? Streaming is brutally competitive and margins are thin, but with Disney involved, the downside looks far more protected than before. Next up, we have a name that got thrown away with the entire space sector after the SpaceX IPO, and it's called ASTS SpaceMobile. They're building the first space-based cellular network that connects directly to your normal smartphone. No special device needed like you need with Starlink. Oceans, mountains, rural areas. Suddenly you have coverage. They've signed agreements with major providers like AT&T, Verizon, and Vodafone, covering a potential 3 billion subscribers worldwide. The bull case is simple. If even a small percentage of phone users pay a few dollars per month for a never lose signal again, this becomes a massive recurring revenue machine. The risks? Launching satellites is expensive and execution needs to stay on schedule. That's why it's an other 5% position and not a 15% heavy weight. Now we go to a sector with a 20% weight in the portfolio, the second biggest allocation, which is the metal miners industry. Why so much? Because the West has woken up to a scary reality. China controls the supply chains for the metals that power everything: EVs, defense, chips, and drones. Governments are now throwing money at fixing this, and these 4 companies are right in the middle of it. And the first and biggest of the 4 is called USA Rare Earth. They are building a complete mine-to-magnet supply chain inside the United States, mining the rare earths in Texas plus a magnet factory in Oklahoma. These rare earth magnets are in every EV motor, wind turbine, fighter jet, and drones, and China controls around 90% of global magnet production. That's a national security problem. With Washington actively funding domestic rare earth projects, we've seen deals like the government taking stakes in this sector, and USAR is positioned as a strategic asset. The risk here? They're still pre-revenue, so this is a story stock. So execution is everything. The second metals miner is called IperionX, and they do for titanium what USAR does for magnets. A fully American titanium supply chain, from Tennessee minerals to finished titanium parts in Virginia. Their secret weapon is technology that produces titanium at lower cost and with less energy than the traditional process, which hasn't fundamentally changed in decades. Titanium is critical for defense, jets, missiles, submarines, and the US currently depends heavily on imports. They already have deals with defense players and the US government, and demand for domestic titanium is only going one direction. The risk? Scaling new production technology from pilot to industrial volume is hard, but the strategic value here is undeniable. Next in line, we got a rare earth mining stock that almost no one is recognizing, which is called Ramaco Resources. On the surface, a coal mining company, but that's not why it's in this portfolio. Their Brook mine in Wyoming sits on one of the largest unconventional rare earth deposits ever found in the United States, discovered by accident in their coal. So you get a profitable, cash-flowing coal business as the floor, with a giant rare earth call option on top. I love setups like this. A real business today and a lottery ticket tomorrow, which is not priced in. The government has shown serious interest in this this deposit, and every step towards production is a potential catalyst. The risk here is that gold prices are cyclical, and the rare earth project still needs at least 2 years, and some extra capital to fully develop. The fourth small cap metal miner that is very quickly becoming a major player is called I-80 Gold. Every portfolio needs a little gold exposure, but I'd rather own a growing miner than a sleepy giant, which depends on gold price appreciation for growth. I-80 Gold owns a portfolio of gold projects in Nevada, the best mining jurisdiction on the planet, with a plan to become a mid-tier producer by bringing multiple mines online. With gold trading at $4,100, every new ounce they produce is extremely profitable. What is the bull case? If gold rises 10%, a junior producer's profits can rise double or triple more than that. But the risk, mining execution, funding needs, and gold price swings. That's the trade-off for the upside. That brings us to the fintech sector, which gets a 10% weight in the portfolio. Two names made it to the spotlight, and those are not Sophie or Melly. One is the biggest digital bank on the planet, the other is an AI lending machine most people have never heard of. First up we got Pagaya. This is an AI network that sits behind banks and lenders. When a lender is about to reject a loan application, Pagaya's AI takes a second look and often finds borrowers who are actually creditworthy. The lender gets more customers and Pagaya takes a fee. And most importantly, the loans don't sit on Pagaya's balance sheet. They're sold to institutional investors. So it's a technology network, not a bank taking credit risk. It's high volume and capital light. They partner with major players. Think SoFi, Klarna, and US traditional banks, and they've just turned profitable, which flipped the entire story. The risk here? If credit markets freeze, loan funding gets harder. And the second fintech stock is a slept-on giant, which is called Nubank. They are the largest digital bank in the world, with over 100 million customers across Brazil, Mexico, and Colombia. Here's the beautiful part. Their cost to serve a customer is a fraction of a traditional bank's, because there are no branches. It's all in the app, and they keep stacking products. Credit cards, loans, investments, insurances, so revenue per customer keeps climbing quarter after quarter. On top of that, this is Warren Buffett approved. Berkshire was an early investor, because of massive growth and real profits, which is rare in fintech. The risk, emerging markets mean currency swings and credit risk in economic downturns, but the execution so far has been world class. Now we got two AI infrastructure stocks that got a 10% weight in the portfolio. One is the picks and shovels of the AI gold rush, and the other is solving AI's biggest bottleneck. The first one is very controversial and is surrounded by negative headlines almost every single day. This stock is called Supermicrocomputers. They build the AI servers that Nvidia's chips need to function in. When a company buys thousands of GPUs, someone has to turn them into working racks. Their edge is speed and liquid cooling. As AI chips get hotter, air cooling can't keep up. And Supermicro is a leader in direct liquid cooling systems. Yes, this stock has had drama. The accounting scare, the recent dilution, the CEO that got arrested, now 2 more employees that are being detained. But they survived it, kept their listing, and demand for AI servers hasn't slowed down, but only increased. To fund their insane demand, they had to dilute shareholders so they are able to ramp up production. Dilution is not always a bad sign. In many cases, you are trading short-term stock performance for long-term growth. After the sell-offs, it trades at a much cheaper valuation than most AI names, while still growing with the AI build-out. The risks are thin margins and fierce competition from Dell and others. For the second stock, we got a bloody beaten down stock, which is called EOS Energy. Everyone talks about chips, but sometimes forget the real problem. The grid can't handle AI. Data centers need massive, stable power, and that's where energy storage explodes. EOS makes zinc-based batteries, an American-made alternative to lithium. They're safer, don't catch fire, last longer, and use no Chinese supply chain. They've received major backing, including a huge Department of Energy loan, and their order backlog has grown to $645 million. The thesis: every data center, every solar farm, every grid operator needs storage. EOS is a pure play on that with a made in USA premium. Now the risks: they're still scaling manufacturing and burning cash. That brings us to the software sector. Previously everyone's favorite, but now the sector that no one looks at anymore. A 10% weight in the portfolio, which is dedicated for 2 under the radar names. No, it's not Microsoft or Palantir. Everyone already owns those. These two are earlier in their story, which means a lot more room to run. First up, we got the multi-bagger that's called MNTN. They make TV advertising available to normal businesses. Historically, TV ads were only for Coca-Cola budgets. MNTN software lets a local gym or web shop run ads on streaming TV with the same simplicity as a Facebook campaign and actually measure the results. Fun fact: Ryan Reynolds is involved evolved through maximum effort, and yes, that celebrity angle genuinely helps their marketing. Connected TV is one of the fastest growing ad markets in the world, as money shifts from cable to streaming, and this stock is the pure play way to ride it. Revenue is expected to grow 20%. The risks? Advertising is cyclical. When the economy slows, ad budgets get cut first. And the last software spot is reserved for another hidden gem. This one is called the Real Brokerage. They are doing to real estate brokerages what Uber did to taxis, replacing expensive offices with a technology platform. Agents join Real because they keep more of their commission and get better tech, including AI tools that handle paperwork and client communication. The result? Real has been one of the fastest growing brokerages in North America, with agent count compounding at more than 35,000 agents across the United States and Canada, and revenue growing double digits while legacy brokerages shrink. The risks? Housing market cycles and thin margins in the core business. But market share gains this fast are hard to ignore. The next sector might take a little longer to play out, but is a must-own, because timing when exactly this sector will explode is difficult. What I do know is that this will happen within the next 2 or 3 years, and this sector is nuclear energy. We will only focus on the miners because choosing which small nuclear reactor stock will win the race is difficult. But there is one thing for sure: we need more uranium out of the ground. AI data centers need insane amounts of 24/7 electricity, and nuclear is the only clean energy source that runs around the clock. Big tech, Microsoft, Google, Amazon, Meta, they're all signing nuclear power deals. Meanwhile, uranium supply has been underinvested for a decade. So I got here 2 must-have uranium miners. The first one is called NexGen Energy. They own the Arrow deposit in Canada, widely considered by far the best undeveloped uranium deposit in the world. The concentrations are absurd. They sit on an uranium deposit that's many times richer than the industry average. When their Rook 1 project comes online, it could single-handedly produce a large chunk of the entire Western world's uranium supply. This is the crown jewel play. If you believe uranium demand and prices are going higher, NexGen is the highest quality name to own. They've already signed contracts with major utilities validating the project. The risks? It's still in development. Permits, construction, and billions in capex is still needed, and timeline slips are the enemy. While NexGen is the future, the next stock is producing uranium today, using a method called ISR. Instead of digging a giant hole, ISR works like a coffee machine. Pump liquid through the underground ore, dissolve the uranium, and pump it back up. It's cheaper, faster, and has lower environmental impact. EnCore is one of the very few American uranium producers at a time when the US has banned Russian uranium and desperately wants domestic supply. They are growing production into rising prices. That's the sweet spot. The risks? Production ramp-ups rarely go perfectly, and costs have been a challenge, but being an active US producer right now is a privileged position, and now the biggest allocation of the whole portfolio. 25% in data center stocks. Why dedicate a quarter of the portfolio? Because AI compute demand is the strongest megatrend of this decade, and the companies that own the power, land, and buildings are printing long-term contracts. These 5 are small caps, meaning if the trend continues, the upside will be unprecedented. Hyperscale Data owns a data center campus in Michigan and is transforming from a messy holding company into a focused AI data center play. The asset is real: land, power access, and infrastructure in place, and they're expanding capacity towards 60 megawatts for AI compute. This is a deep value turnaround play. The market cap is tiny compared to what a fully built out AI data center capacity is worth. The risks? Dilution and execution. This is the most speculative name in the video. Keep it a 5% position max. Next up, we got a stock that is likely to explode higher, with some major catalysts coming soon. Vivo Power recently completely rebranded around one mission: owning and leasing AI data centers, with their flagship being a fully operational 41.5 megawatt data center in northern Norway. Running on 100% renewable hydropower, Norway is a cheat code for data centers: cold climate for free cooling, cheap clean hydro energy, and political stability. And here's the big catalyst. They just selected a preferred long-term AI tenant for the Norway site, described as a global AI industry leader, with the name and contract details expected very soon. If that announcement lands with a big name attached, this story changes overnight. Their angle is sovereign AI, helping nations keep their AI compute and data under their own control, with assets across Norway, Finland, and the UAE. The risks? They are still small, still unprofitable, and everything depends on signing and executing these leases. But the risk/reward is really attractive, and that's exactly why it made the list. Next up, we got an under-the-radar stock that's called HIVE Digital. They started as a green Bitcoin miner with hydro-powered facilities in Canada, Sweden, and Paraguay. But the real story is the pivot, converting that power and infrastructure into AI cloud computing. Here's why miners pivoting to AI is such a powerful trade. They already own the 2 hardest things to get: powered facilities and energy contracts. Getting a grid connection today takes years. HIVE already has them. AI hosting revenue is growing fast. fast, and it's much more stable than Bitcoin mining income. So you get two engines: Bitcoin exposure when crypto runs, plus a growing AI compute business underneath. The risks: Bitcoin volatility still moves this stock, and the AI segment needs to keep scaling. But of the miner to AI pivots, HIVE's cheap energy angle makes it my pick. The fourth data center stock with a power pipeline of more than 4 gigawatts is called Soluna Holdings. They have a genius business model. They build data centers next to renewable energy plants and buy the electricity that would otherwise be wasted. Wind farms often produce power at night that nobody uses. That means ultra cheap green power, the single biggest cost for any data center. They started with Bitcoin mining, but are shifting toward AI compute hosting, where the margins and contracts are much better. Their project pipeline has grown to 4 gigawatts, which is enormous compared to their current size. But the risks? It's a microcap that needs capital to build, and the pivot from mining to AI has to actually deliver. Next, we got the Asia data center stock play. Gorilla Technology builds AI infrastructure and smart city systems for governments, security AI, network intelligence, and now full sovereign AI data center projects. Their contracts are the story. They've announced massive government deals in Asia, the Middle East, and beyond. With a pipeline worth multiples of their current revenue, government contracts mean long durations and sticky relationships. Once you build a nation's AI infrastructure, they don't switch vendors easily. The stock is wildly volatile, but the direction of the business, from small projects to nation-scale AI deals, is what I'm betting on. The risks are that government deals can be slow, lumpy, and hard to verify until revenue actually lands. Notice the design. No single stock is more than a 5% weight in the portfolio. That's intentional. For a portfolio that is focused on growth, position sizing is your seatbelt. Any one of these could potentially get cut in half, and all of them could triple at any time. The portfolio is built so the winners can carry the potential losers. If you made it this far, which stock do you think is the best pick in this portfolio, and which one would you kick out? Drop it in the comments, I read all of them. Smash the like button if this gave you ideas, subscribe for weekly stock breakdowns, and I'll see you in the next one. Peace.